we've changed the personal lines outlook to stable from negative, in line with the corresponding change in the personal auto outlook, also to stable from negative. These two are closely connected as the subsegment represents over half the premiums in the personal line space. The homeowner's outlook was last refreshed in March of 2024 and remained at negative. Carriers in the personal line space have been impacted by inflation, a hardened reinsurance market, shifting weather patterns, and considerable rate need, which led to volatility in operating performance and capital levels. The combined ratio for the segment peaked in 2022 at 109.1, also recording a material decline in capital that year. Results started to improve in 2023 and continue to do so in 2024, again materially influenced by improvement in personal auto. The stable outlook reflects the progress many carriers have made to achieve rate adequacy, particularly in personal auto, where it was not uncommon to see double-digit rate increases in recent periods. In part, this was achieved as some regulatory bodies became more accommodating and recognized the need to approve rate increases amid challenging macroeconomic conditions. In several cases, those offering personal auto coverage benefited from 6-month policies, which allowed carriers to achieve rate increases at a faster pace when compared to those offering 12-month homeowner and auto policies. Many carriers have incorporated more sophisticated technology and systems to enhance their ability to segment pricing and analyze risk exposures, allowing for more granular risk-based pricing. Another contributing tailwind is an improved interest rate environment that led to higher bond yields and thus net investment income. Nonetheless, carriers offering personal property coverage continue to contend with ongoing volatility driven by heightened weather activity, cost influence adjustments to reinsurance protections that have increased retained losses, and a new norm in expected loss costs. While the change in outlook indicates a calmer dynamic within the industry, we expect carriers to continue to refine pricing capabilities and risk exposure analyses in an effort to stay ahead of the macro trends that caused pressure these past few years. Adjustments to reinsurance programs, combined with erosion in capital from operating volatility, has led to several carriers' risk-adjusted capitalization declining, largely eroding the capital cushion many had built up, but remaining in a solid position. While with this in mind, AM Best will closely monitor individual risk-adjusted capitalization levels and their sustainability. Improved investment yields and premiums that have yet to earn in from implemented rate increases across the segment are anticipated to further benefit operating results. Carriers are expected to continue to evaluate risk concentrations and enhance catastrophe mitigation strategies, with many adjusting their risk appetites this past year. As is customary, we'll continue to monitor the reinsurance environment and the potential impact it may have on risk exposure and operating results. However, the January renewals is expected to be smoother than in prior years.